All right, we're going to go back in time to 1999. Now think about the scene. The dot-com bubble is just reaching its absolute peak, and Warren Buffett, one of the greatest investors of all time, is having one of his worst years ever. So today, we're going to tear apart his annual letter from that year. It's really a masterclass in accountability, rational thinking, and how to create value for the long haul. And let me tell you, it's just as crucial for us as investors today as it was back then. Let's get into it. So Buffett kicks off his letter not with a bunch of excuses, but with this. I mean, think about that. It is a stunningly direct admission of failure. You know, in a world where CEOs blame literally anything but themselves, this kind of raw ownership is the first huge lesson. It really sets the bar for the kind of leadership you should be looking for. And this is the so-called crime he's confessing to. A measly 0.5% gain in per-share book value for the entire year. Now remember, the S&P 500 was absolutely screaming higher, so compared to that, this was a massive, colossal failure. But Buffett doesn't try to hide the number, right? He puts it right there, front and center. Okay, so this brings us to our first section. We're really looking at how Buffett frames this terrible year, not as some random bad luck, but as a personal failing in his single most important job. You know, what's so remarkable here is just how precise his self-critique is. He doesn't just say, hey, I did a bad job. He tells you exactly why. His one subject, his only real job as CEO, is capital allocation, deciding where to put the company's money. So by giving himself a D, he's telling shareholders exactly where things went wrong in the investment portfolio.
So how does a master like Buffett deal with a period where his entire strategy is so painfully out of style? Well, he goes straight back to first principles. This next part is all about the intellectual bedrock that keeps him anchored, and honestly, it's a framework every serious investor needs, a ruthless, relentless focus on intrinsic value.
Buffett knows that book value, especially after a year like 1999, just doesn't tell you the whole story. So what he does is he offers a much more practical way for shareholders to figure out what the business is actually worth. And this is a fantastic tool you can use to analyze any kind of complex holding company.
And this table just illustrates his method perfectly. He basically says, look, think of Berkshire as two completely separate businesses. On one side, you've got the investment portfolio, all the stocks and bonds. And on the other, you've got the pre-tax earnings from all the operating businesses, See's Candies, the furniture stores, all that stuff. By looking at these two pillars on their own, you get a much, much clearer picture of the company's real earning power. And you can see that huge operating loss in 1999, he points out it was driven by a massive and what he called an aberrational underwriting loss at General Re.
Now, here's the key. The value of those operating businesses is way, way higher than what you see on the balance sheet. And a huge reason for that is this idea of economic goodwill. You see, the accounting rules back then forced companies to write down goodwill over time. But Buffett argues that the real goodwill, the brand power of a company like See's Candies, actually grows in value. This gap between accounting fiction and economic reality, well, that's where smart investors find all sorts of hidden value.
Okay, and all of this leads us to the company's true economic engine, the insurance business. To really get Berkshire, you have to understand this. This isn't just another one of their operations, it's the financial core that fuels literally everything else they do. Buffett explains that the real magic here is something called float. It's actually a pretty simple concept. Step 1. The insurance companies collect premiums from customers up front. Step 2. They get to hold on to that cash, the float, and they invest it for Berkshire's benefit. And step 3, they pay out any claims much, much later. So that huge pile of money, which they're holding but don't technically own, becomes this enormous source of capital for them to invest.
And I mean, just look at the sheer scale of this engine. It went from just $20 million back in 1967 to over $25 billion by the end of 1999. But Buffett is adamant. He says the size of the float isn't even the most important thing. The most vital question for any of us when we're analyzing an insurer is this.
What did it actually cost to get that $25 billion? See, if an insurer pays out more in claims and expenses than it brings in from premiums, that's called an underwriting loss. And that loss is the cost of your float. In 1999, that cost was 5.8%. Not amazing, but the goal is to always keep that cost below what you'd pay to borrow money in the open market. And in many, many years, Berkshire's cost was actually negative, meaning they were literally being paid to hold and invest billions of dollars of other people's money.
So, with all that capital that the float is generating, we come right back to Buffett's one subject. How do you deploy it intelligently?
This section is really a playbook for investors on how to judge a management team's skill at allocating capital, and we're going to look at acquisitions and share repurchases.
This just shows you the fundamental difference in strategy. Wall Street, as you know, it runs on investment bankers, on these crazy auction processes, and what Buffett hilariously calls books that read like Superman comics. So what's Berkshire's strategy? They just wait for the phone to ring. Seriously, they build a reputation where great business owners who want to find a permanent, stable home for the company they built call them. It's a strategy that's built entirely on trust, not on generating fees.
All right, so next, Buffett gives us this brilliantly simple and rational test for share buybacks. It's a test you can apply to any company you're looking at. Rule number 1, does the company have more cash than it needs for the business? And rule number 2, is the stock selling for less than a conservative estimate of its intrinsic value? If the answer to both is yes, then buying back your own stock is often the single best investment you can make.
But then he gives this critical warning. Back in 1999, and it's still true today, a lot of companies buy back their shares not because the stock is cheap, but just to prop up the stock price. This, he says, is an ignoble reason. It helps the shareholders who are selling out at the direct expense of the ones who are staying. It's basically a transfer of wealth from the loyal owners, not to them.
And all of this builds up to a final and absolutely crucial lesson. When he was facing the dot-com mania, where everybody and their brother felt like a genius, Buffett's discipline was his defining strength. And it all came down to this one simple idea.
This circle of competence. Buffett is just completely, unashamedly honest about what he doesn't know. He had no idea which of these new tech companies would have a real, durable competitive advantage in 10 or 20 years. So, you know what? He just didn't play the game. The lesson for us as investors is so profound. It's not about how big your circle is. It's about knowing exactly where the edge is. Armed with that kind of discipline, he then offered this incredibly sober and, as it turned out, dead-on correct forecast for the market. While everyone else was expecting 20% returns forever, Buffett laid out a much simpler and much more rational model. His logic was just simple common sense. In the long run, corporate profits as a whole can't grow much faster than the economy itself, so real GDP growth. You start there with about 3% real GDP growth. You add about 2% for inflation, and then maybe you tack on another 1% or 2% for dividends. That gets you to a total expected return for the whole market of maybe 6–7%. That's a tiny fraction of what people were expecting. It was just a massive dose of reality in a completely euphoric market.
Which brings us to the final question, right? After walking through one of the worst years of his entire career, what's the single most important lesson that we should take away from this incredible letter?
And here it is, the ultimate takeaway. The very same principles that made Buffett underperform so badly during the bubble, his refusal to overpay, his focus on businesses he could actually understand, his disciplined valuation framework, those were the exact same principles that protected Berkshire shareholders from the devastating crash that came right after.
And he just leaves us with this unforgettable line. It's a timeless warning against getting seduced by complicated stories and confident predictions about the market. In a year of total failure, Warren Buffett didn't offer excuses or fancy reasons. He gave us a masterclass in rational, disciplined thinking, a lesson that is still the absolute bedrock of sound investing.